Hello everyone, my name is Matt Stearns and I'm creating this video today to share some information about bonds, what they are, how they work, and I really want to share this video right now because bonds have come back into vogue with what has happened to interest rates over the last 24 months or so, especially with interest rates going from 0% from the pandemic up to 5%. It created a huge move in bonds. Now bonds look more attractive as an investing vehicle, but in a lot of ways, bonds are complicated. There's a lot of jargon that we use in the bond world that a lot of people don't understand. So I want to cover the fundamentals today about what bonds are, how their prices move, what affects their prices, and what's some of the jargon that we use to describe bonds. Okay, so just simply, what is a bond? A bond's a loan that investors buy for the promise of payments and security. The easiest way that I find for an individual to think about a bond is think about you being the bank. You're taking your money, you're loaning it to another entity. It could be the US government, it could be Apple, for example, and they agree to pay you a fixed interest rate over a fixed amount of time. That is a bond, the same thing as a mortgage. A bank gives you $200,000, you agree to a 4% mortgage, you pay them 4% interest for those 30 years or whatever you agree to be the mortgage term. Bonds work a little bit differently. So, how they work in reality is, for example, say the US government needs $1 million. They issue a number of bonds, and each bond costs $1,000. So, you can buy 100 bonds or you could buy one bond. But to keep the example simple today, we're just going to pretend that we buy one bond, okay? And this one bond is priced at 5% for 5 years. So they need the money, right? And you say, okay, I think you're good for it, US government. I'm going to give you $1,000 and you're going to pay me 5% interest. So 5% interest on $1,000 is $50. So you're going to pay me $50 every single year. And then after those 5 years are over, you're going to give me my $1,000 back. All right. So that's how a bond works in the real world, essentially. And it's a little bit different than that mortgage example, but you can think of the bond as an investment vehicle. It's something that you can purchase to generate wealth, albeit you have to take into some factors, making sure that the person that you're lending the money to is going to pay you that interest and then pay you your full principal in the future. So there are different issuers that issue bonds, but the most common is the US government. It's the biggest bond issuer in the entire world, and we call those bonds treasury bonds because they're issued by the United States Treasury. Then there's other types of bonds like municipal bonds. Say Vernon Township, for example, they want to build a roundabout. They say, all right, we need to raise $10 million for this project. They sell bonds to the public through different ways. And then there's also corporate bonds, which are also a very common type of bond investment vehicle when companies need to raise money. So sometimes they'll issue stock. They'll say, okay, we'll sell 10% of our company and give you stock. That'd be ownership in our company. You have to buy that stock, but there's really no guarantee attached to it. You're only buying that stock with the hope that the company becomes more valuable and you can sell that stock to a different person at a later date and it's more valuable because the business has generated increasing profits over the years. But for a bond, they're saying, hey, we need to raise money. We're going to pay you a fixed amount of money and then whatever you pay us in the upfront, we'll give you it back at the end. Okay, so those are the common types of bonds that you see in the investment world. So there are a couple important factors when considering to buy a bond that are really common sense, but these are things that really factor into how bonds are issued, how much interest they pay, and how they fluctuate after they're issued. So the most important thing is credit quality. Are you dealing with someone who is very reliable that you're certain you're going to get your money back from them in the future? If so, for example, might be the United States government that has the ability to print their own currency if they need to, make interest payments. So we would say their credit quality is AAA, for example. Um, Anything higher than triple B, so it goes AAA, double A, triple B, and then there's also plus and minus. So you could be A plus, and then there's an A, and then there's an A minus. So there's many, many tiers in this ladder. Anything rated above triple B we call investment grade. All right. Anything below that we call high yield. So this is a term that a lot of investors have heard before. I want to purchase high yield bonds. Okay, so high yield basically doesn't mean anything other than the fact that you're purchasing a bond from an issuer that doesn't have great credit quality. They call it high yield because of that risk, they should be paying you higher interest payments. All right, and we'll talk a little bit about the word yield um, in the future. But that's all that high yield means. It's an issuer that has lower credit quality, so inherently there are more risks with purchasing high yield debt or bonds. Okay, let's move on here. The other factor that is really key in understanding bonds is how long the bond agreement is going to last for. We call this duration. Very important word in the bond world today. Every bond has a fixed interest rate and a fixed duration, a fixed term. That could be as short as 30 days. It could be as long as 30. There's even been bonds that have been issued for 100 years, for example. But the key point is that the longer the duration of the bond, the longer that they're going to be forced to pay you this fixed interest rate, the more risk there is because you're involving more time for things to happen. And that obviously increases the amount of risk that that issuer won't be able to pay you the interest payments or your principal back at the end. Okay. So obviously, investors can purchase a bond and they can be receiving interest rate, but at any point in time, they can sell their bond in the open market. Okay, so we have to kind of separate our brains between purchasing that bond up front and holding it together versus the open market where people want to buy and sell bonds after they're issued or after they've been held for a little while. Okay. Um, People buy and sell bonds because they think that newer bonds are going to have a different interest rate. Okay. And I'll talk about this in the future, but if you think that your bond's going to become more valuable in the future, you would wait and you would become a seller if that were to happen. So you might sell your bonds, but we'll talk a little bit in the future about what causes bond prices to go up or down. Okay, but the main thing to remember, okay, is that bonds will always pay 100% of the original agreed upon face value of that bond. So in the previous example, we paid $1,000 for the bond. Okay, it's going to pay us $50 in interest every year, 5% interest rate, and at the end they're going to give us $1,000 back. Those two things never change. If you purchase a bond from somebody in the open market after it's existed for a couple years, they're still going to pay you whatever that bond in the contract says it's going to pay you, that interest rate, and it's going to pay you back that $1,000 at the end in our example. So that's critical to understand as a bond investor, okay? So let's look at an example now. You purchase a $1,000 US Treasury bond at 5% interest for 5 years, all right? That bond is going to pay you $50 every year. That's where the 5% comes from. Then after the 5 years, they're going to pay you $1,000 back, okay? But you have it for 3 years and you decide I need to sell it for some reason. Now the government is selling 5-year bonds at 3% for $1,000 because that's the prevailing interest rates 3 years later. And this bond, of course, is paying investors $30 annually. Okay, because your bond is paying $50 a year, your bond that you own now is more valuable than the currently issued bonds that are also selling for $1,000. Okay, because of this, if you go to sell your bond, people will have to pay you extra to acquire it because yours is paying more than the 3% interest, and they were both being issued at $1,000. So they're both going to pay $1,000 at the end of it, but yours is going to pay higher interest in the meantime. So your bond now is worth $1,040, and that's because it's going to pay $20 extra in year 4 and in year 5. Okay, so that is how the mechanics of bond pricing works and how prices fluctuate after they've been issued. So assuming that obviously our bond issuer, the company that we agreed with, is not going to default, okay, if you buy a bond and you never sell it in the open market, there is really no risk if you knew for a fact that it was going to be around. That's why sometimes you'll hear people say that short-term US Treasury bills are risk-free, because unless the government ceases to exist in the next 30 to 90 days, for example, you will get the principal that you put up, your interest payment, and then your principal back at the end. Okay? If you buy a bond at a certain rate and the prevailing rates go lower, like the example I just told you, the bond that you have is more valuable. Okay? And vice versa, if you buy a bond and it's paying 5% interest, but new interest rates go up to 7%, your bond is less valuable. So as an investor, when we invest in bond funds, for example, these funds, they own thousands and thousands of bonds inside of them. What makes the value of that fund go up and down is what's happening with interest rates outside of that bond fund relative. Okay, so are interest rates going up compared to all those bonds that are owned inside that bond fund, or interest rates going lower? And so that's what drives bond prices or bond fund prices. Okay, so you must understand the relationship that as interest rates go up relative to what you own, okay, so assume you own something, if interest rates go up, your bonds become less valuable. All right, and this is exactly what happened in 2022, really the beginning of 2022 until now. Interest rates that are really set by the Federal Reserve went from 0% to 5%, 5.25% now. That rise in interest rates have caused everybody's bonds that they own to go down because every day new bonds are being issued at higher and higher interest rates. Okay, but now where we're at is bonds are offering an attractive interest rate. So now you can buy a 10-year treasury bond at 5%. And if you hold it for 10 years and you don't go to sell it, it doesn't matter what happens in the marketplace. You'll get $50 interest payments every year. And then in year 10, you'll get your $1,000 back. Okay. But for investors that own bond funds where there's many bonds that are inside of it, or you're someone that is expecting to trade your bond at a given time, what happens relative to interest rates relative to what you had purchased your bond at is extremely important. And so that's the understanding that I really want you to take away today, is that interest rates and how they move affect the price of your bonds, and they're inversely related. Okay, as one goes up, the other prices go down. As rates go up, prices go down. As rates go down, prices go up. Okay. So a couple other things that affect prices is a few things. Credit is one thing. So bonds can fluctuate in price if, let's say you bought a bond from Tesla, okay, a 5-year bond paying 5% from Tesla, but they're not selling any cars. all of a sudden they have to issue more and more bonds, they're increasing their debt, their balance sheet's getting worse, they're losing money. All of a sudden, as an investor, as a bondholder, you say, oh no, they might not be able to pay me my interest and my $1,000 5 years from now. So even though the nothing really happened with interest rates per se, their credit is becoming more risky. Okay, and so this can affect bond prices. The other big thing that affects how prices move is duration. All right, duration is the word that we use for how long, and I covered this earlier, how long that bond is going to be issued for. All right, in general, as duration increases, bond prices fluctuate more. Okay, so let's say, for example, you have a 10-year treasury at 5% and new bonds are offered at 4%. Okay, your bond will increase in price roughly 10%. So it typically matches the amount of duration, a 1% interest rate move. Okay, so in this case, it went from 5%, new bonds at 4%, interest rates went down 1%, the value of your bond went up 10%. Okay, if you had a 30-year bond, for example, and rates go down 1%, your bond would go up 30% in value. Okay, so an example two, let's say you buy a 2-year corporate bond at 2%. New bonds are offered at 6%. That's bad news for you because everybody's going to want the 6% bonds, not the 2% bonds. So your bonds will decrease in value roughly 8%. So that's a 4% interest rate difference multiplied by the 2 years. So that's kind of a rule of thumb. And this is really where bond investing really pays to know these rules. And this is how professionals position bonds and bond funds and things in your portfolio. You can really dramatically impact a portfolio depending on the duration of bonds. You can have really secure bonds with really great credit from the US Treasury, but they can fluctuate tremendously based on the duration of the bond. So, for example, in today's environment, there are a lot of risks. It looks like recession might be coming on. So you might say, okay, I don't want to own a bond from a risky company. I want to own US Treasury bonds because I'm pretty sure no matter what happens, they're going to pay me. Well, that's fine. That's good. You don't have to worry about the credit side of the picture. But the duration is going to also affect how much that price moves. So if you buy a 30-year bond at 5% and interest rates go up to 6%, you'll lose 30% of your value if you wanted to sell it. Okay? And vice versa, if bonds go from 5% down to 2%, you would see a 90% increase in the value of those bonds. So duration is a huge factor, and it's really a way to affect how much money you're going to make in the bond market. And another thing I want to say about that is all the time people refer to bonds as being less risky. And in the bond world, there are major factors that contribute to how much bond prices fluctuate. So it's really not accurate to say that bonds are less risky than stocks. Just like stocks, it depends on what type of bonds you're buying. Okay, so I can't stress that enough. All right, so I want to cover what yields mean. This is a technical term. It's a little bit hard to wrap your head around, but I want to introduce the idea to you. So you'll hear people on television talking about yields. They'll say, all right, the 10-year is yielding 4.75%, or the yield went up 0.1% today. So imagine that over the course of 1 year, the US government issues 10-year treasury bonds at 3% in January, 3.5% in June, and 3.25% in September. Okay? And now it's December, for example. All of those bonds are going to have their own individual market price because each of them are going to be worth a little bit different amount because they all have different interest payments attached to them, and the interest rates have gone up to 4%. Okay, so if you purchase a bond in December, all right, that bond is still going to pay you. Let's say you purchase in December, you go back and you purchase the 3.5% bond in June. That bond is still going to pay you $35 a year. Okay, it's still going to pay you $1,000 at the end, but you're going to have to pay a different price for it. All right, and the same thing with the 3.25% issuance in September. All right, what yields do is they tell us what the prevailing market agreed upon interest rate is at any given moment in time for a particular issuance. So let's say in this case it's 10-year treasury bonds. The yield is changing constantly based on what the market is predicting for future interest rates. Okay, so the yield on, let's say when you want to purchase it, might be 4.15 in December. Your bond that you own or that you want to buy, the 3.5% in June, is going to have its price based on the current yield. And that current yield is based on where all the different types of bonds are trading at, because we can't look at every single issuance of bonds and get the price like you can for a stock price. That's not how it works. They aggregate everything that's being traded based on the price and get the effective market-based interest rate. So that's what yields are. They are the current interest rate that the market is prescribing to that particular time, irregardless of what anybody paid for it in the past. But that's what affects the price that you would have to sell at or pay if you wanted to get rid of your bond or purchase a new one. Okay? So yields are the market adjusted interest rate. And here's an example of treasury yields, for example, over the last week. So you can see the rates for all the different durations of bonds that the US Treasury government has issued. All right, and you can see that they fluctuate a fair amount just day to day. So a 1-month Treasury is paying 5.58%, and a 10-year Treasury is paying 4.6%, for example. So you have a bond and you're sitting at home and you say, man, I bought this 10-year Treasury bond at 3.5%, and it's paying me. I'm happy with it. But what you would do is you would look at the 10-year yield and you say, all right, right now it's yielding 4.58%, and that percentage will tell you what price you would have to sell that bond at in the open market. So it's basically saying, yeah, interest rates went up at you. Right now we're basing the 10-year interest rate at 4.58. Your bonds, at 3%. So you're going to have to sell it at a little bit of a loss. So hopefully, when you see those things on TV, you can kind of start to think about, okay, that's what yields mean. Yields are the market rate for each individual issuance. Okay, so this went a little bit longer than I wanted to, but wrapping your head around bonds is something that will take months and months of practice and understanding and research. But hopefully you take some things away from this presentation about what bonds are and what affects the movement of them and how you can think about them as an investor when people say, oh, future interest rates, the Federal Reserve says, you know what, we got a big bad recession, war, whatever, we're going to have to cut interest rates. Oh, okay. What does that mean? If we're going to cut interest rates, that means that the bond market is going to go up in value, right? So if you can understand those fundamental things, you will be better prepared to be a bond investor and more knowledgeable as to what it means and how it can affect your portfolio. So that's what I have for you today. Thank you for tuning in, and can't wait to share with you some more next time. Bye-bye.